Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We from Group G will present the impact of credit risk management in performance of Islamic Bank for Al-Rajhi Bank and Alliance Islamic Bank. Nowadays, the banking system is developing in line with the modernization of the world, which implies the continuity of concepts and ideas that have been introduced by banks to the public. Due to the nature of the bank business portfolio, Al-Rajhi Bank and Alliance Islamic Bank will face credit risk. Therefore, credit risk management is one of the needs that need to be emphasized to ensure that the bank can survive and remain viable in the face of fears in the competition in the banking industry. The main purpose of credit risk management is to maintain credit risk exposure within safe and acceptable parameter. Although bank cannot be completely insulated against the credit risk, bank can reduce credit risk in various ways. The management of credit risk can be made by identifying the risk and taking into consideration why this risk rise and what caused them. It also can be managed by developing a solid and stable risk management infrastructure and adhering to all specific standards. Next, we will discuss the overall ratio analysis on the performance of the Al-Rajhi Bank and Alliance Islamic Banks. First and foremost, for the operational risk, the bank leverage is a metric that used to assess the level of debt owned by banks and its ability to repay the financial obligation. The higher the leverage ratio, the higher the probability that the bank will be able to sustain unexpected impacts on its balance sheet. All Al-Rajhi Banks and Alliance Islamic Bank leverage ratio were higher than Basel III minimum amount, which is 3%. Therefore, both banks will be able to support their respective bank in the event of the future unforeseen crisis. On the other hand, the concentration ratio will illustrate the size of the bank in relation to the entire banking industry, and the Herfinda Hirschman Index (HHI) is an alternative metric of firm size. 0% to 50% of concentration ratio is low concentration and has a level of perfect competitiveness. Meanwhile, 60% and above is oligopoly. HHI that below than 1,500 considered as competitive market, HHI between 1,500 and 2,500 considered as moderately concentrated market, and HHI above 2,500 considered as highly concentrated market. Therefore, the banking industry concentration ratio is 54% and value of the HHI calculation is 262. As a result, these two aspects prove that the banking industry is highly competitive, that has a lot of competition and competes with each other well.
Asset quality refers to the overall risk associated with the numerous assets held by individual or entity. Based on the chart, we can see that both banks show different trends. Al-Rajhi are more towards downward trends, while Alliance banks are on the other hand is more fluctuating but eventually increasing. This shows that Alliance Bank has a bad asset quality compared to Al-Rajhi Bank. Bad asset quality can cause a bank rating downgrade that it becomes more difficult to earn depositor trust. Such bank can therefore only attract deposit by having a higher deposit rate, while good asset quality means it tends to have more profitable. Next, cost-to-income ratio. Cost-to-income ratio is a tool used to measure the efficiency of a bank. It shows how much the Islamic bank spends to maintain its outstanding financing portfolio by expressing operating expenses as a percentage of typical portfolios. According to the chart, it can be seen that Alliance Bank recorded a decrease while Al-Rajhi Bank is fluctuating but eventually increasing. Evidently, Alliance Bank has a bigger operating expense compared to Al-Rajhi Bank. A high cost-to-income ratio could mean a number of problems, including inefficient bank management and excessive competition in the market. The business must either raise operational income or decrease operating expense in order to lower this ratio. Next, the equity ratio. The equity ratio is a financial indicator that calculates the amount of leverage used by a company. From the chart above, you can see that both companies have a fluctuating trend. However, Al-Rajhi is prone to downward while Alliance Bank is prone to upward. The ratio is a stronger indicator of how well money is managed and how likely it is that the company will be able to pay off its debt on time. The higher the ratio, the better. Last but not least, liquidity ratio. Liquidity ratio is a type of financial ratio used to determine a company's ability to pay its short-term debt obligations. According to the chart above, you can see that both banks have a fluctuating trend. However, Al-Rajhi is prone to downward, while Alliance Bank is prone to upward. Surprisingly, in 2016 until 2010, both banks have a ratio of greater than 1. It can be concluded that both companies are able to satisfy their current bills.
Okay,
Okay, next, I will continue with the profitability ratio analysis. In this ratio, there are several types of profitability ratio analysis that we are measuring. So the first profitability ratio is the net interest margin. The objective of this study on net interest margin is to determine the bank's growth and the profitability. As we can see in the graph, the net interest margin for Alliance Islamic Bank and Al-Rajhi Bank have an insignificant difference in amount with each other, where the net interest margin for Alliance Islamic Bank is nearly 5%, while the net interest margin for Al-Rajhi Bank is over 5%. So the trend for this bank is actually the same, and this show that Alliance Islamic Bank and Al-Rajhi Bank have similar strategy in terms of managing their net interest margin. Overall, we could see that Alliance Islamic Bank and Al-Rajhi Bank have managed to achieve consistent growth in their net interest margin. Furthermore, the second profitability ratio is the return on average equity, which it reveals how well the firm can generate profit from its shareholders' equity. So based on the graph, it's shown that the trend for the return on average equity of Alliance Islamic Bank from 2016 to 2019 is increasing steadily. So this is a positive indicator for the bank, as it is making efficient use of its shareholders' capital to generate profit. As for the reason of Alliance Islamic Bank's return on average equity falling in 2020 and 2021, it is likely was due to the pandemic that adversely affected the global economy in 2020. So in comparison to that, return on average equity of Al-Rajhi Bank has been shown that from 2016 to 2019, the return on average equity fluctuates inconsistently, with the highest rate recorded in 2019 at 4.04%. However, in 2020, Al-Rajhi Bank recorded a steady decline in return on average equity with a negative of 9.14%. So this decline can be due to a drop in demand for financial services as a result of pandemic. And Al-Rajhi Bank is slowly recovering in 2021 with a return on average equity of 1.76%. So overall, we could say that return on average equity of both banks differ from each other, as it reveals how much better the Alliance Islamic Bank can generate profit from its shareholders' equity than Al-Rajhi Bank.
Now I will proceed the return on asset. Return on asset is showing the percentage of how profitable the assets of a bank are in generating revenue. According to this graph, we can see in 2016, Al-Rajhi Bank had the highest return on asset, which is 0.022%, then Alliance Bank, which is 0.017%. In 2018, Al-Rajhi Bank has increased to 0.026% and continued to rise in 2019, which reached the highest value of 0.030%. Meanwhile, Alliance Bank had slightly decreased in 2018 and rose in 2019, which also got the highest value, which is 0.022%. In 2020 and 2021, it will reduce as the bank has a negative impact on net income or heaviness in an entity's asset holdings, and also because of pandemic of COVID-19. Next, return on equity. Return on equity is measure the rate of profit that holders of a company's common stock make on their investments. According to this graph for Al-Rajhi Bank and Alliance Bank, for Al-Rajhi Bank, the return on equity kept increasing consistently from 2016 until 2019 and will drop in 2020. Luckily, in 2021, it got the highest ratio, which is 0.32. Meanwhile, for Alliance Bank, the flow is unstable and not consistent compared to Al-Rajhi Bank. We can see from the graph, it shows that the bank has total expenses exceeding its income on the income statement. But in 2021, Alliance Bank has a lowest return on equity, which is nearest to zero. This means the bank is still inefficient in managing its profits generating assets. And last but not least, for profitability ratio is earning per share. As we know, earning per share is a popular statistic for determining corporate value and showing how much money a firm produces for each share of its stock. Investors will pay more for a firm's share if they believe the company has larger earnings relative to its share price. A higher earning per share denotes more value. According to the graph, we can see earning per share for Alliance Bank has increased from 2016 until 2019, and it will drop to 2020 and will drop again 2021. Luckily, in 2021, earning per share for Alliance Bank has a lowest value, which is 1.8. The value of earning per share for Al-Rajhi Bank has a negative value in 2020, which is negative 6.60. This value has cause of a company issues new share, as in the case of rights and bonus as example. So basically, we can conclude that from this graph, Alliance Bank has a good earning per share which has a higher value than Al-Rajhi Bank.
Next, I will continue with credit risk. Credit risk refer to the risk that a borrower not repay the money borrowed from the bank within the time period provided in the contract. There are two types of ratios that measure a bank's ability to handle its risky credit exposure, which are the capital adequacy ratio and non-performing financing ratio. The capital adequacy ratio is a measure used to evaluate a bank's financial health that takes into account both its capital and its asset. Both banks have fluctuated pattern. However, Al-Rajhi is prone to downward, while Alliance Bank is likely to upward pattern. Al-Rajhi Bank recorded the highest in 2017 at 23%, meanwhile Alliance Bank recorded the highest in 2021 at 21.57%. Al-Rajhi Bank have the better performance compared to Alliance Bank. However, from 2016 until 2021, both banks have passed the requirement credit adequacy ratio from BNM. That means they have the sufficient capital to sustain a significant loss. Secondly, non-performing financing ratio. Non-performing financing refer to loans that are not being repaid due to the borrower's lack of money or other unusual circumstance. The pattern graph of Al-Rajhi Bank shows a falling tendency, with the highest ratio in 2018 being 0.95%. Alliance Bank had fluctuating patterns, with the greatest ratio of 2.30% in 2021. Al-Rajhi Bank ratios for these 6 years are below 1%, indicating that Al-Rajhi Bank is at low risk for their outstanding loans. Meanwhile, Alliance Bank has a high ratio for more than 1% every year. A high ratio means that the bank has a loss if the owing amounts are not collected. So we can see that Alliance Bank has the high risk compared to Al-Rajhi Bank.
Next, for the Z-score, the graph shows the fluctuation with small chunks up and down. Both bands are determined to be in a distress zone, which is below 1.8. The highest value in the previous 6 years for the both bands was in 2019. At the beginning of the COVID-19 pandemic in 2020, the value decreased. From that point, it's become clear that the bank is impacted by the COVID-19 pandemic. In 2021 and below, it is revealed that neither bank was ever placed in the grey zone or safe zone. It is because almost 14 until 70% of the banker would conclude that the primary reason is the lack of qualified and experienced banker in selecting, managing, and evaluating profitable projects. In conclusion, the chance of bankruptcy would be significantly higher if the management company did not immediately take action to evaluate the company's financial condition. Next, possible factors that could influence the credit risk. First, lack of management efficiency. It is because of the limited resources, high costs, and lack of technological maturization to evaluate and monitor risk in a real time. Islamic banks face crucial challenges in improving their risk management strategy as they are exposed to various types of risks, such as operational risk that is caused by the failure of control, procedures, and information technology system. The second factor is the bank failure to identify the 5 C's of individual borrower ability to repay their debt. It is consists of character, capital, capacity, collateral, and condition. The more the financial institution assesses the potential customer credit history, the more the borrower will be evaluated by the bank. Next, unemployment. Due to the high number of business closures and an increase in the unemployed, COVID-19 has exposed Islamic Bank to an increase in non-performing financing or credit default risk. The low moratorium and repayment flexibility might cause insufficient funds for the bank primary function.
Next, I'll be presenting technique to mitigate credit risk. Credit risk is one of major issues to which any financial institution, including Islamic banks, must pay attention to. By applying KYC concept and Hamis Jidiyah, credit risk can be mitigated. Knowing your customer, or also known as KYC, is one of the important mitigation techniques any line of business should apply in. It is a significant process of identifying and verifying the client's identity when opening an account. Only correct and current information about a person or business can be used to evaluate their credit profile. While on the other hand, Hamis Jidiyah is an amount of money given by one party to another as a guarantee to later purchase or lease a certain asset from that owner. Its main purpose is to limit the extent of losses and damages suffered by the bank in case the customer does not fulfill this obligation. It can be concluded that implementing both techniques is good to mitigate credit risk.
For risk monitoring and controlling step, the first step is a risk management plan. Alliance Bank and Al Rajhi Bank should process the kind of document and use it while predicting the risk on the project. This plan will address the risk identification, risk document, risk mitigation, risk contingency planning, risk measurement, and risk tracking and reporting. If banks do not address all of these risks, the institution could suffer the large losses. Next, other step is risk register, which includes the process of identifying risks and owners, risk responses, triggers, and warning signs. Both banks, which are Alliance Bank and Al Rajhi Bank, need to identify and assess the potential risks in the banking business. The next step is to identify variation like changes in order or changes in request. Consequently, the purpose of the step is to identify any specific alteration that could affect the project.
Lastly, the risk monitoring and controlling step is conducting an assessment. So this includes properly tracking and evaluating the performance of risk management activities. So this can help bank to identify potential problem and deficiency and make any necessary changes to improve the ability to manage the risk. This also can help to reduce the extent of the risk. So therefore, it is important for Islamic Bank to have a system of risk monitoring and control in place in order to identify, assess, manage, and control any potential risks that may arise in the future.
Next is recommendation for better risk management. When it comes to risk management, it needs to be followed by managing the risks that experience large losses first compared to risks that have a lower probability of loss. First, the bank must choose their customer based on assessment made through 5C, which is character, capacity, capital, collateral, and condition. This 5C assessment is designed to assist banks to choose their customer more effectively so that each of their customers is able to manage their financing need to avoid widespread of credit risk. In addition to this, if a customer does not fulfill the minimal criteria, banks are given the option of entering into an agreement with them or not. Second, the bank can manage risk by using appropriate and suitable strategies such as avoidance, sharing, retention, and reduction of risk. However, the risk cannot be completely eliminated, but it can be controlled and managed through monitoring and supervision from the bank. As a response, banks are encouraged to monitor and evaluate risk exposure of the bank continuously and proactively. Lastly, for the conclusion, the profitability of bank asset in generating income for Al Rajhi Bank and Alliance Islamic Bank can be evaluated in the ratio of return on asset (ROA). Furthermore, an increasing ROA indicates that the bank is earning more profit relative to its entire asset, while decreasing ROA means that the bank is earning a lower profit relative to its entire asset. Based on the calculation that have been made, it can be seen that Al-Rajhi Bank has outperformed and higher return on asset than Alliance Islamic Bank for 6 consecutive years. This proves that Al-Rajhi Bank has gained and increased profit compared to Alliance Islamic Bank that experiencing financial problems and poor investment for the 6 years in a row. That's all from us. Thank you.